Let's start with introductions. For those who don't know me, my name's Richard Betts. I'm the publisher at Real Asset Media. We run a series of around 70 of these events a year, and also have specific programs at Expo Real as well as MIPIM. We publish magazines based on the general market called Real Asset Insight and Real Asset Impact, which is looking specifically at sustainability, social impact initiatives and how those are influencing the market. But really great panel here. So let's start with some introductions. Let's start with you, Tobias. Just a quick minute on yourself and what you do.
Thank you very much, Richard. So, hello everybody. My name is Tobias Schultheiß. I'm the founder and owner of Blackbird Real Estate, which is a Frankfurt-based transaction advisory boutique with offices in Munich and Cologne. Our focus is on advisory for buying and selling properties, but we also do co-invest and initiate joint ventures with a value-add opportunistic approach. The company is 11 years old. On average, we do 3 to 4 deals per year. That's basically me. And us.
Thanks, Rebekah.
Hello, everyone. Thanks, Richard, for having me. Rebekah Tobias. I'm a managing director with MARCOL, which is a private investment firm. We are pan-European investors in real estate and private equity. Our main focus in Germany in particular is operational real estate and self-storage. Specifically, actually, Tobias sourced us one of our sites in Essen. We're mainly converting obsolete retail, repurposing assets to turn them into operational assets, and the storage sector in particular, which I'll go into more detail, is of a particular focus for us at the moment.
Super, thanks. Alex.
Yeah, Alexander Lehnen, international tax partner of Arnecke Sibeth. We are a large national German law firm, law and tax firm, serving mainly clients in the real estate and infrastructure sector.
Rainer Nonnengässer. I'm representing International Campus. We are developer, operator, investor in student housing and young professional living. We cover Germany, Austria, and the Netherlands. We currently have 8,000 units in our universe.
Perfect, thank you. Let's start with you, Tobias. You were on this panel last year at Expo Real in 2021. Plainly a number of differences, but I suppose what are the key ones for you between 2021 and now?
Just look at the audience. It's, I would say, 20% of what was sitting here last year. Thank you for coming. And I think this is also a sign for the situation in the German market. There is an interest, but there are no deals. Last year we had deals, and just earlier today I read the news research from Savills stating that the year-to-year comparison, Q3 21 to Q3 22, it's more or less the same transaction volume, but last year we had a stable deal flow. The last 4 months, almost no deal happened. So that's my comparison to 21 and this year.
And a lot of uncertainty in the market, quite plainly. What I would like to say, though, is that the audience this year is significantly more attractive, I think, than the audience last year. So I think there's a very, very positive thing there in terms of the audience. Rebekah, let's just pick up you. I mean, you've obviously been tracking the German market. What are you seeing as the differences? What are the challenges at the moment? We're obviously all aware of issues with financing, issues with the interest rates, economics, geopolitics. But I suppose, what are you seeing as the most crucial of those, and how's that influenced what you're thinking about in terms of the German market?
Yes, thanks, Richard. I would say if we were general commercial buyers of real estate at the moment, it'd be far more difficult. I think certainly what's impacting Germany from a liquidity point of view at the moment is the energy crisis, because that is certainly having a far greater impact on German energy prices. And we're seeing that there's obviously caps coming in terms of how high you can heat your buildings. And for office users, that's going to be much greater impact. For storage, we don't have to heat our stores above 17 degrees. So apart from a small area for reception. So I think we're going to see less of an impact there, but we're starting to see there's significant headwinds generally in terms of the international appetite coming into Germany. However, there are still deals happening, I think. Transactional volume is certainly lower, but we're seeing a lot of off-market deals, particularly if you're equity-rich family office buyers don't require leverage or can maybe leverage or, refinance after acquisition. And those buyers are actually taking advantage of the opportunities in the market at the moment, which I still think are quite significant. If you're a core plus buyer, it's going to be very difficult to finance anything if you're buying below a 5-6% yield, which is difficult to find in Germany anyway. But the German market, I think, has obviously very long-term good fundamentals for real estate. And so we're long-term investors. And I think you always have to be having that long-term view in mind. And we're going to see the appetite come back, certainly. But the big uncertainty at the moment is just the energy crisis, I think, for us.
Alex, do you want to pick that up?
Yeah, of course. So I would recommend international investors to prepare for the MIPIM next year. So I guess 2023 we will see lots of opportunities, and hopefully, or I would expect that international private equity capital will come back to Germany after a disappearance of nearly 5 to 10 years. So in the last years, we only saw some landmark transactions or mainly logistics transactions of greater foreign investors. And I'm pretty sure that the smaller, mid-sized private equity investors will come back to Germany next year.
So you see there being quite a changeover in terms of the sorts of investors that are looking at Germany at the moment.
Yeah. We saw a decade of German special and institutional funds buying at low yields in any asset class, and I guess these times are gone and will decrease to a very, very limited level mainly due to the increased interest rates. And these days we mainly see, as you said, we see mere equity investors. They are pushy mainly in the field of resi these days. But next year, I guess the sellers will have adopt their expectations.
Okay, good. And Rainer, let's pick that up with you. Obviously, very much focused on the resi sector and aspects of resi. What are you seeing there? Are you seeing difference in terms of the types of investors who are looking? How's the economic and energy crisis and those kinds of things influencing what you're seeing in the capital markets?
Well, if you look into the German resi sector, regardless which subsegment it is, primarily developments or bigger scale developments are funded by foreign equity. Those are the usual pots of capital that we all know. And in principle, everybody was more or less taken by surprise. I'm not saying it was not foreseeable, but let's say it was pretty drastic, seeing interest rates going up to where they are currently. And if you're sitting on a pool of capital that you have raised in 17, 18 or 19, price tags doesn't fit anymore. So even if there would be something to invest in, the cost of capital would not be suitable anymore. And that's why, in principle, all the PE companies are currently sitting on their hands, letting commitments go, raise new funds earlier next year. And as Alex said, everybody wants to be ready to rumble again around MIPIM, meaning Q1 next year. And I think it will be interesting to see how the transactions that have happened this year really look like. If you take a closer look, my gut feeling is there's a lot of spillover from last year, especially in Q1 and Q2, signing last year, closing somewhere this year. Then you have a lot of transactions that consequently took place by pure or overweight equity buyers who out of a sudden had the opportunity to get access to deals. And now you are in a situation that they're all gone. So the pure equity buyers are not buying anymore because of potential overpricing. The highly geared investors are, as just said, sitting on their hands. So I don't see a lot of change in who is looking into the market. It's just an interim phase. Everybody's pausing activities and waiting for the dust to settle, and underwriting metrics for next year to be set and to be agreed to be able to continue activities.
And is there a real mismatch between kind of buyers and sellers and their positions in terms of, what sellers will accept and obviously what buyers will offer?
Absolutely. And in Germany we have that saying, the appetite comes with the eating. And I met a lot of advisors over the couple of weeks who concentrate on vendor and technical due diligence. And all of them told me that they have a lot of work to do because German sellers team up and they want to sell property. So as per now, I fully agree with you, Reinhard. The interest may be there, but the capital is not there. But I think that this year we won't see much deals anymore. But next year, at around MIPIM, this will, hopefully take speed again, and we will then have a normal, whatever normal is, market again.
So, and is this because you expect pricing to have stabilized, values to have stabilized, and actually at the moment there's just so much uncertainty that
nobody wants to be the first one to buy a property because he may overprice or overpay for the deal. And unfortunately, we in Germany, where we have the sustainable rent in Anglo-Saxon markets, sellers and buyers react much faster on market changes. So when I look in Dublin, we did a deal earlier this year in Dublin, and my fellow SIR friends over there, they tell me that the big retreat just began. Because 5 years ago, big private equity investors bought almost the whole of Dublin. They bought it at multipliers we don't know anymore, below 15. And now our building was sold at a net initial yield of around 4%. But this seller told me I could even sell it at 5%. I would still make a bargain out of it. Unfortunately, we do not have this fast reaction in Germany from sellers. But as I said, the appetite comes with the eating. First sellers who bring properties to market will burn their fingers. Then they will readjust the pricing. And then they will sell. Not at high multiples, but at acceptable multiples.
I mean, it's interesting. And so at the moment in the market, are we going to see, obviously financing rates have gone up. Is that going to leave some assets underwater in terms of their covenants? Is that going to bring some things onto the market, or are the banks still able to extend and pretend to a certain while if they believe this is a short-term issue? What's the sense of that, Alex?
I would not expect that the banks will take consequences so fast. That the German banks are not the pushy banks that will request any sales forces within the next half year. So I would not see that fire sales within the next months.
No, I think unless you have a refinancing situation, that you've bought something 5 years, 10 years or whenever ago, and now face completely different interest environment, that might be a push. I expect over time land banking to become under pressure. When the typically smaller equity piece is eaten up and the underlying mezzanine slowly but surely gets on fire, there might be some pressure coming from that end. But the banks per se are so solidly financed, I don't see that there will be a lot of push from that angle.
So German institutional funds most times financed for 10 years. And if you look 10 years ago, we had the same interest rates like now, or similar interest rates. So there will be in the refinancing round of long-term financing, you will see interest rates like they had before. So I do not see the pressure.
That's interesting. Yep.
Although where we have seen an opportunity is now for the alternative lenders to come into the German market, whereas previously obviously dominated by the German banks. So we've closed our portfolio financing in May with an alternative lender who were desperate to get into the German market. Thankfully that closed in before the interest rate rises. But we actually, it wasn't just one, we had a handful of alternative lenders wanting to do this deal. So I think there's a lot of scope, even on the refi, for these lenders to do more deals in Germany, which is never a bad thing. And also the debt capital markets, although there's still a lot of liquidity, obviously it's lower leverage, higher rates, but I do think when the activity starts coming back, there'll be opportunities there, certainly, for all.
And are we seeing, you mentioned there that it was a time, Rebekah, earlier for all equity, really, that equity players were going to be king here. Does that mean we're going to see more of the sort of, I suppose, ultra high net worth, those kinds of family offices who are equity rich coming more into the market now? I mean, is it a buy opportunity for them when others are not in the market?
There are different German family offices that came in the market within the last year, and they are very keen on doing such some distressed deals now. But so far, we don't see the international multifamily offices coming back.
Okay, so you're seeing it from German domestic money.
Only domestic.
Okay, good. Let's pick up a little bit on the fundamentals. Given that we're not expecting to see too many deals, although you'll be hoping to see some, Rebekah, I guess, until next year. What are the fundamentals like in terms of, I guess, rental, occupancy levels? Any sectors that you're working on, feel free to come up with those. I mean, Tobias, what are you seeing, office sector, for example? I mean, is there a lot of occupancy issues there or not?
That's the irritating thing. On the one side, we have this massive uncertainty with inflation, rising interest rates, with the supply chain issues. That's why we don't have an investment market right now. But when you look at the office letting market, it looks like doing business as usual. We don't have increasing vacancy rates. We don't have reduced rental levels. They are more or less stable, average and top rents. So it's a working market. So the fundamentals from the letting side are okay, but there's no investor believing in it. So that's why we don't have deals. Yeah. Same with when you look at resi. I'm not a resi professional, but
last year we haven't anticipated the investment crisis that we have now. And I guess this year we do not anticipate the rental crisis that will up when the German economy slows down beginning of next year. So
do you think there will be? I mean, I'm going to come to you in a second because I think the area that you're in is interesting there, Rebekah. But from your point of view, in the areas where you're operating, Rainer, what's your view on occupancy, rental rates? What are you expecting to see? I mean, does business carry on as normal despite everything that's going on in your sector, or?
In principle, on the resi side in Germany, you have a situation that rents are rising and will be rising in the next years due to the imbalance between demand and offer. Not only in our sector, but also in the multifamily sector over the last years, a formula has been established that the vast majority of the developers' profit was fed by KfW subsidies. They have disappeared overnight in January, which led to a complete collapse of new build resi developments in Germany, which also affects the sector we're in. So the development trend has significantly scaled down here. And this will lead to a situation that over the next 2 to 3 years, you have limited to no growth on the supply side, and you have an increasing demand. On the student side, we have a situation that we are now post-COVID. The internationals are coming back, so Chinese, Australian, South Americans, US, which has led in our portfolio and in those portfolios of our competitors to a point that they were fully let pretty early in the letting cycle. And if you look into multifamily, the vacancy rates in urban areas are historically low, and you still have double-digit rental growth, and that, from my point of view, will because of the just mentioned factors, continue at least for the next 2 to 3 years. The completely other side of the coin is the landlord's perspective, where you have an increasing top line and need to manage energy price evolution, inflation, to make sure that your NOI is not completely eaten up by these effects.
Okay, good. Rebekah, let's drill down a little bit into the sector that you're looking at. So what are the key drivers for the self-storage side? I suppose, what are you looking for in terms of, I mean, you mentioned their redevelopment from retail, for example. So I suppose, what's the strategy, what's the opportunity, and what are you looking for?
So I was saying earlier, slightly different in that we're not really able to benchmark a lot of our assumptions in Germany because there's just a lack of self-storage in general in the market, which is also where the opportunity is. So on one hand, we're in markets where there's absolutely no competition, which is great, but underwriting assumptions is a bit of a, finger in the air, as they say. We are seeing very good traction on the lease-up side. So what drives demand in storage is, unfortunately, death, divorce, downsizing, and dislocation, all of which we've seen through COVID and going into the next cycle. So we're expecting actually a very good demand side to come through the turmoil in the markets, and that's been shown in the listed market if you track it through the last crash in self-storage. But there is a huge product awareness problem that we do have, because if you ask participants in a recent survey if they've ever heard of self-storage in Germany, and only maybe 20% will say yes. So we have a long way to go to get there in terms of a new sector and a new market. But we are now 20 sites which we've acquired over the last 2.5 years through COVID, and because we're repurposing, we're buying off a 10% yield on cost, which is a good benchmark. So even if financing rates obviously are going up, we're not as concerned if we're able to still get those sites for 10% yield on cost. So that's our sort of benchmark there. And it's, repositioning retail. I think everywhere they're looking at what are we going to do with these obsolete retail buildings. So for us, that is definitely the main focus. And we're continuing to buy. The issue is we're not buying off sophisticated institutional investors who are worried about trading at a 20% discount. We're buying off private individuals who are not that in touch with what's happening in the market generally. And so if you go for the price chip based on, debt pricing going up, they're just say, well, we're not distressed, we don't need to sell, and therefore I'm happy to just sit on my asset until you pay me what I want. So there's a balance there that we need to strike. But again, we're not buying it for its existing use. So the value that we're buying off, which is self-storage values, are much higher. The market opportunities will be there, certainly. And I think if you're bold enough to make decisions in today's market, then you'll find opportunities. But again, as Tobias was saying, no one wants to catch the falling knife, and how low will prices, trend going forward. So everyone's in a price discovery mode, which was the takeaway, I think, of Expo so far.
For sure. It'd be interesting to pick up a bit on ESG, which is a big topic here at Expo Real. Always quite Dutch market always very big on that, but German market as well, I think. So Tobias, if we move to its kind of green or nothing, and what happens? Because obviously a lot of the secondary stock, a lot of the smaller towns, for example, the stock is older, doesn't meet the criteria. So I suppose what's happening, and is there a transformation opportunity that you see there?
I think there has to be this transformation, maybe not from the current owners, but from future ones, because we all heard this word stranded assets. I do own stock in small cities with 30 to 50,000 inhabitants, and the good thing is these banks they're still, at least back then 5 years ago, they give money to local and regional lenders, and they did not know about ESG or sustainability. That's something they heard from the big 7 cities, but 5 years ago they did not hear about it. Today I would say they start to becoming aware of they have to do something. We hear about green leases, green finance. which I still not yet understand what both means. But on the other side, the most important thing of these three letters is the E for ecology. And the easiest way to become sustainable is, for example, just build a photovoltaic roof system on the rooftop of your building. And then you are maybe not in terms of social and governance, but you did an ecological change of your building. My impression is that local, small, private individuals as owners, they just don't want to think about this. They say, listen, I own this property for 20 years, it has always been fully let, so why should I change something? That's the approach. And even when I talk to insurance companies, they say, we know we have to do it, but we don't want to do it. Earlier today I talked to a big institutional investor here from Munich who said, yes, we want to have a service provider who will take care of all of it. We don't want to. We may rent our roofs to an investor, but we are happy to get a rent for it, but we don't want to have anything to do with it.
So maybe let me tell an interesting story. Last Friday, the first German office fund, according to the Sustainable Finance Act, so a so-called Article 9 fund, that was the first fund that was established at MIPIM times, I would say, so a half year ago. They had the focus to build to ESG or refurbish to ESG. And they decided last Friday to stop their business. As obviously German institutionals are not longer interested in a managed to ESG or a rebuild to ESG strategy. What is quite surprising for me, as I would suppose that the times of the fund of these fund would come up now. The last half year was difficult, of course, to find some property, but within the next 1 or 2 years, I would see that fund on the best way prepared for that future phase. But they stopped their business due to missing interest of German institutional investors. And that was surprising for me, and I could not understand that, but it showed us that German institutionals or the German mid-sized pension funds and so on, they will no longer be that extensively in the German real estate market as they were in the last decade. So they would only buy ESG compliant assets, but they are not able or willing to invest in the rebuilding of ESG compliant assets.
Okay, that's interesting. There's a session tomorrow on capital flows.
That's a huge opportunity for the internationals for next year in 2024.
I mean, it's definitely going to be. We've got a session tomorrow on global capital flows and some of the trends there. And I know that's a question because I wrote them. But that's an interesting point because I hadn't heard that. But I do know there's a lot of capital being raised at the moment for transformation, for certain.
But I'm quite surprised about that because certainly Germany especially should be pushing towards investing in more renewable energy sources, obviously, as everyone needs to become more self-sufficient. But we're putting solar panels on our buildings, which I think is a small step towards, also having to be able to source our own energy for our buildings, but also, investing in renewables. But the price of solar panels has come down 90%. The issue now is, over the last 10 years, the issue now is finding them and being able to source them, because there are significant supply chain issues as well with those renewable energy sources. But I'm quite surprised to hear that.
Rainer, I just wondered, you mentioned a little bit about the student housing side and the micro-living side, but maybe just give us, it was interesting that international students are coming back. I saw that as well in the UK. We're beginning, having last year had almost no international students, that now they're beginning to come back, including Chinese students, interestingly. So what are you seeing there as some of the key trends? And I suppose how resilient is that as a sector?
Well, if you look into the last years, we had an unforeseeable hit by COVID, where most of the universities converted to online, and nobody in the sector had a master plan in the drawer how to deal with the global pandemic. but I think all of them who are active in the sector have managed quite well. And by nature, the young people had a desperate wish to leave home whenever they were again able to leave home. And already last year it was quite visible that occupancies picked up. It was more on a domestic context with a European angle, as a lot of Erasmus students were floating around in Europe. And as mentioned earlier, this year the internationals are coming back. And in most of the European markets, and Germany is in continental Europe the biggest as regards student numbers, the supply-demand imbalance is pretty obvious. We see in the Netherlands first trends of limiting the inflow of international students, to be seen whether this comes into force. In Germany, we are in principle quite open to foreigners and support the intake of foreigners, but we need to take into consideration we have 3 million full-time students. My guess would be there are, including non-profit organizations, some 280 to 300,000 beds. So the vast majority needs to go through the multi-family residential market, laying grounds for another push on rents and increasing competition with families for a stock that is in most of the relevant spots not sufficient to meet the demand.
And is there any pressure from, because obviously if you're going to be getting increased costs of energy, people in the commercial world, but for sure in the residential world, will be beginning to either look at the total cost of what their living involves. But are there cases in Germany where, for example, energy is already the responsibility of the landlord, of the owner, where then they're going to have to absorb that? So what's the situation there?
We are here in principle in an interim situation, as the administration is trying to sort out ways on how to cope with rising energy cost. There are plans for limitation on gas prices, on electricity and so on, but there is still no clear picture. For sure, utilities have become a kind of a second rent in addition to the underlying cold rent. And most of the players in the PBSA market have in the last years already focused on achieving high energy efficiency in their buildings, as most of them, including us, operate on an all-in basis. So we don't do separate utility billings, and therefore have a very strong interest that utilities can be managed in an efficient way. But looking into the rental residential market, and this is then the link to the just happened discussion on the E and ESG, some 50% of the current stock is lower quartile as regards energy efficiency and needs transformation. First question, transformation to where, with which means, which technology? And second question, who should pay for the transformation bill? Yeah? And here everybody's waiting for the administration to come up with programs of subsidies or other kinds of motivation for landlords and private owners mainly to increase the energy efficiency of their buildings. Yeah? And so far it's not foreseeable how this should look like. Yeah? And it's becoming a more and more pressing item.
So last week the German government announced to spend 200 billion euros to protect the German tenants from energy costs or rising energy costs. So that will enlarge the period of the transformation, as the German government will pay the bill for a period, however it will take, and that of course will reduce the speed of the transformation.
I'm just going to come to the last one here, which is, obviously it's it's relatively, not relatively easy, that's the wrong thing to say, but it's easier for sure to make investments in a rising market and do well. In a falling market, much more challenging. And we've discussed there about nobody wants to catch the knife. But I suppose, where do we see the opportunities if we think the market is going to be coming back over the next couple of quarters? Where do we see the opportunities? What strategies do we think will work in this current market? Let's start with you, Tobias.
Last year it was easier to answer it.
That is true.
Well, I think cash buyers, all cash buyers, they have the opportunity to buy whatever they want because they buy with cash. We won't see finance at acceptable rates in the next, I would say, up to 6 months. So where do I see opportunities? Not like last year where I said go to B, C, and D locations. I would look at buildings, either office or hotels or serviced apartments with long-term leases where you can generate stable income. That's something where we currently put our focus on as a transaction advisor, because the investors we do work with, they like stability. And we don't have stability right now, so this is something where we focus on. And as an investor, we shifted from real estate towards solar panels, photovoltaic. This is our personal program for the next, I would say, 12 months. Gather as much roofs as possible in order to build photovoltaic roof systems.
Okay, interesting. Rebekah.
Of course, I'm going to say self-storage, but also senior living. So we've been doing a lot of research in the healthcare real estate sector. Obviously, there's a massive demographic play around providing better quality homes for elderly care and senior living. So we've been exploring that market. I think in Germany, there's huge scope there to do something. And just touching back on the international appetite, getting into certain markets. So a recent example of this would have been Norge buying into 50% stake of Sony Center in Berlin with Oxford Properties, and that recently occurred. And that was a prime example of strategic relationships, wanting to get into the market, and a much long-term view, going back to the long-term view. These are investors that are going to hold for 10, 15, maybe 20 years. And so are they worried that they're getting into the market and there's a potential dip to come, but, valuations will stabilize at some point? They're really not. So I think in very specific cases, that's a one-off. There's still transactions happening to get into those core markets.
I would recommend international managers to collect international private equity capital until the MIPIM, and then have a good rebuild to ESG strategy beyond the German top sevens. So go to B and C's subsidies and buy all elderly office or resi buildings and transform that to ESG core objects.
Okay, great. Rainer.
I think going forward, residential will provide a lot of opportunities, regardless which subsegment you look in, starting from student to senior living. There is a lot of demography supporting it. There's a lot of supply-demand mismatch that supports it. And finally, I think the energy booster, given the low quality of the existing stock, will also provide opportunities for repositioning and for new build in this area.
Great, really interesting. Thanks very much for all of your insights on that.